I continue to believe that the momentum must be established by gold. The narrative has to be established by gold. If that happens, and I believe it will, experience tells me that silver will move later, but silver will move further and silver will move faster. In my experience, silver moves later. The momentum has to be established by gold. The last movers of all are the silver stocks. Silver has to move before the silver stocks move. My suspicion is that if we do see rate cut, that we are going to see strength in gold and silver equities.
In a current analysis of the gold and silver markets, commodities investing legend RickRule, founder of Rule Investment Media, shares insights into the impact of U.S. dollar depreciation and offers strategies for investing in precious metals. Rule expresses confidence in gold and silver, anticipating that silver will eventually surpass gold in speed and extent of value increase. This sentiment aligns with historical trends, as the CME Group noted that silver has often outperformed gold during periods of robust economic expansion, mainly when industrial economies thrive. In 2010, silver outperformed gold, reaching 30-year highs with an impressive 80% price increase. Another surge occurred in April 2011, when silver peaked at $48.84. Rule emphasizes his experience-based observation that silver tends to follow gold, but with a delay. He underscored the role of fear in driving bull markets for gold, citing instances such as the 1970s when concerns about U.S. dollar depreciation and changes in gold price regulations fueled a significant gold bull market. The recent bull market started in 2018, when gold hit $1,160. Silver lagged gold for 2 years, as it did in the early 1970s, before staging a similar catch-up rally in the summer of 2020. Silver would surge nearly 150%. Just like in 1974, silver's catch-up was a sign the first leg of the bull move had ended. Rule expresses a suspicion that if there is a rate cut, there will be strength in gold, silver, and their respective equities. Gold prices rose on Tuesday due to declining U.S. dollar and Treasury yields. Investors are anticipating upcoming U.S. economic data for insights into the Federal Reserve's interest rate plans. Meanwhile, silver prices remain steady at around $23.92 as investors await crucial economic data and Federal Reserve updates. In what way does fear play a significant role in driving bull markets for gold, as emphasized by Rule? What are your thoughts on this? Let's delve into key moments from RickRule interview with these video clips.
Gold is hitting new all-time highs in nominal terms, not inflation-adjusted terms. I think that the gold market is, as we described it the last time you and I talked, a coiled spring. And I think it's wrong, at least from my own viewpoint, as an old guy, to think of gold as a speculative element. I think you think of gold as an insurance element.
Right.
You may not recall, but the last time you and I talked, I said that I didn't own gold because I thought it might go from 1,950 to 2,110. I owned it because I thought it might go over 5 years to 8,000 or 9,000 or 10,000, at least in nominal terms, based on the declining purchasing power of the U.S. dollar. I continue to believe that the momentum must be established by gold. The narrative has to be established by gold. If that happens, and I believe it will, experience tells me that silver will move later, but silver will move further and silver will move faster. I own silver in the speculative part of my portfolio. I own gold in the insurance part of my portfolio. So I hope that helps. Could this be a false start in gold? Sure, absolutely. And you have to organize your portfolio to understand that you might be early. Precious metals bull markets have, for the 50 years that I've been watching them, been led by fear. The predominant ethos of the 1970s gold bull market was at once the deregulation in the U.S. of the gold price, but also the fear of the policy of guns and butter, the fear of the depreciation of the purchasing power of the U.S. dollar. Similarly, the 2000 gold bull market led off by fears in a decline of the purchasing power of U.S. dollar-denominated savings, which has occurred again. In my experience, and I can't tell you why, sadly, Ivan, in my experience, silver moves later. The momentum has to be established by gold. The last movers of all are the silver stocks. Silver has to move before the silver stocks move. As we've discussed before, the market capitalization of the legitimate silver stocks in the market is so small that when and if the generalist money comes into them, as Doug Casey so inelegantly says, it's like siphoning Hoover Dam through a garden hose. I'm not trying to be inflammatory with my speech, What I'm trying to say is that if past is prologue, it will pay you to wait, because when the silver stocks do move, they likely will make up for all of the trauma that they have caused you up until that point. My suspicion is that if we do see rate cut, that we are going to see strength in gold and silver equities, simply because the faithful believe that happy days are here again. And I think, in other words, I think the market will in effect pass the collection plate through the choir, but we won't add to the congregation. Later on, when it becomes apparent to savers that the real rate of deterioration of the purchasing power of the US dollar is about 7% compounded, if you include stuff like tax in the cost of living.
Oh, yeah.
When people understand that their purchasing power is deteriorating by 7% compounded, and they're being paid 4% or less on their CDs or 10-year treasuries, it's at that point in time, which corresponds to the end of 1975, early 1976, that gold, silver, and the precious metal stocks go absolutely ballistic. When the average saver looks at the government and says, those bastards got me again, that's, I think, when the circumstance, the narrative that's driven so many people collides with reality.
RickRule advises speculators to keenly observe the market's response in different scenarios, particularly emphasizing the need for those holding speculative gold and silver stocks to consider the possibility of speculative capital diverting to technology rather than precious metals. Recent market dynamics have witnessed gold reclaiming attention in stock and commodity markets, surging to record highs. This resurgence is attributed to the perception that gold is a hedge against inflation, a coveted asset for investors seeking to safeguard their wealth amid economic uncertainties. Adding to the narrative, financial giant Goldman Sachs forecasts a series of rate cuts by the Federal Reserve, anticipating a 25 basis point reduction 3 times consecutively between March and June. Furthermore, they predict additional easing measures over the year's second half. RickRule outlines 3 potential scenarios. Firstly, the Fed chairman may need to follow through or could be misleading. Secondly, discussing lower rates might instill confidence without actual cuts. And thirdly, the economy might reveal unexpected strength despite prevailing expectations. Let's get back to the interview.
Speculators who believe that this is nirvana need to think about 3 things. It might be that the Fed chairman is lying. It might be that simply jawboning about lower rates will re-inject confidence into the economy.
That's probably true.
And so I think that investors need to test their perception to the downside. I'm not saying he won't do it. I'm saying that the economy is surprisingly strong, given a doubling of interest rates, and he may not have to cut rates. I suspect that he is loath to cut rates because of the fiscal irresponsibility of Congress. So he will only cut rates if he has to. If he does have to, then really it's going to be a function of the market's response in various circumstances. To the extent that your listeners are holding speculative gold and silver stocks, one thing that they need to consider is the amount of speculative capital that will go into technology rather than into gold and silver. So I think that people who, again, believe that rate cut is nirvana need to understand that they need to pay attention to the market's response in the near term to cutting. In the longer term, while the real inflation rate stays much higher than the Fed acknowledges, while the compensation available to investors in savings products declines, I think what you'll see is, in a normalized world, the real response in gold and silver would take place 2 years or 2.5 years after the rate cut.
Oh, wow.
I think you might see a move in anticipation, but it's important to note that what really drives gold and silver is investor and saver expectation as to the maintenance or lack of maintenance of their purchasing power in US dollar terms. And that doesn't happen in 3 months. We've had 40 years of a strong dollar and declining interest rates. And the idea that you can unlearn the lessons that you've learned in 40 years over 3 months or 4 months is fairly silly. If I had a criticism, and I'm just going to be honest with you, if I had a criticism of the Wall Street silver market, the sort of Reddit market, it's that the orientation of the speculator has been very much narrative and very much in the short term.
Yeah, we want everything to happen quick.
And that's not what happens. I remember myself as a young person. I had trauma holding stock over a long weekend, which means I didn't make as much money as I make now,
Right.
being willing to own stocks for 3 years, 4 years, or 5 years. So it's important that your audience adjust their expectation to the probabilities, understanding too that their narrative is only ever a probability, not a certainty,
Right.
and adjusting both their psyche and their pocketbook to that reality.
With recent market dynamics leading to gold's surge to record highs, how is this resurgence linked to the perception of gold as a hedge against inflation in the face of economic uncertainties? How might the potential diversion of speculative capital to technology rather than precious metals impact the dynamics of the gold and silver markets? Share your thoughts in the comments section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.